Hi, David here, CEO and founder of the Freedom Founders Mastermind community. I have a lot of conversations during the week with constituent members of Freedom Founders. I have a lot of real estate professionals who provide a lot of opportunities for myself and our community in different aspects of real estate investing in the alternative space. And I'm really connected to a even larger network of business owners and real estate and finance people from really all over the nation and really internationally. It's my job. I feel it's like my duty, and really something I love to do is be connected because I love information. I'm always been curious in my life about different things, and I want to know for myself. And I'm sure many of you are the same way. The problem is we just only have so much time to gather up all the information on different subjects that we're interested in. And so the way I really fold time or collapse time for myself is I just plug myself in with try to do so with the right people, and that takes time, right? I'm not here to talk about network relationships, although it's really one of the foundational principles I found in my life that's allowed me to move the needle in the directions I've wanted to go, whether it's through challenges or taking new opportunities, but really getting me to a stage in my life as early as I could in my career where I had more freedom of time and not in that grinding wheel of going over and over again. But really my main focus to you today in my message is really the narrative, the communication, the conversation, if you will, if you want to call it that I think is being played out in the general media regarding the financial markets and the economy. And when I say financial markets, I'm talking about broad here. I'm talking about everything financial, whether it's the Wall Street financials or alternative investments like real estate that I look at. It could be crypto, it could be tech stocks, it could be precious metals, you name it. I'm just talking about broad-based. My basic premise here right now in the middle of September in the third quarter of 2023 is that there is a narrative that is way overly optimistic about where things are going. And it's really been this way, I think, really, all during COVID. We came out of COVID with all the stimulus money, the Federal Reserve, the Treasury, Congress, all coming to the rescue. And I'm saying there had to be some rescue, but as anything's done, it's overblown, it's inefficient. Money in many cases went to people who didn't need the money. And we have this overblown economy that's based on what? Hot air, fiat currency. And now the chickens will come home to roost, so to speak. That money train is running out. We have debt that's spiraling out of control. We have a Congress that is spending like drunken sailors, like it doesn't even matter anymore. And this will not continue. So while I've been talking about a correction or recession for some time, and some people call me on that. Well, David, you'll get it right sometime, and the clock is right twice a day, et cetera, et cetera. I get it, but that's okay. That's okay because I'd rather cut my potential long-term losses than try to eke out a final bull run market gain that people are so proud of. Well, that's great, but we all say we can't time the market exactly. So I'd rather be safe and take higher ground sooner. My point is the narrative today is overly optimistic, and there's a lot of complacency. A lot of people are saying, well, there's a lot of room left to run in this market, whether, again, you're talking about the financial markets or in real estate. I focus more on real estate, so I'm going to focus there right now because that's what people come to me for. It's like, David, what's your take on the marketplace right now? I've been saying for many quarters, going way back to last year, that I've been staying away or pulling money out of or not going back in primarily to equities. That's ownership. Whether you like short-term rentals or rental properties or strip malls or commercial multifamily or self-storage or mobile home park communities or retail or office or industrial or hotel, tourism, you name it, I am not going there. I don't care what people tell me about what kind of deal they're getting right now, whether it's you buying it for yourself or you're buying through somebody else, a syndication or a fund. In most cases, you're putting your money in at the top of a market that's only going to come down in valuations. It's only going to come down. Oh, people say, well, the interest rates are going to come down. The Fed's going to reverse course and it's all going to... I don't think so. I think we got the inflation problem with the spending of the government and the Fed's mandate to get inflation down, and they're going to have to keep interest rates higher for longer. They could even go up a little bit higher than they are right now. And we're only beginning to see the beginning of the lag effect of what interest rates do when they've gone up as fast as they've gone in the last 18 months. We've never seen it go up this fast before. The damage has already been done. It's just not been felt or witnessed yet. That's what people don't get. Oh, they've raised the interest rates this high, and gosh, the economy's still good, and people are still buying, and people are still traveling, and just you wait. Again, I'm not a fearmonger. I'm not a doom and gloomer. I'm just saying that the narrative that many of you are believing and reading and wanting to believe, and I get it, is a narrative that's not going to play out. So I would be very careful if you're new to this game of investing, particularly if you're investing in real estate and alternatives. And many people are going to these conferences, and I'm just saying you're late to the game. I'm not saying don't get involved. I'm not saying you shouldn't be there learning, listening. But if I were you, I'd hold off. I wouldn't jump in with both feet like a lot of people want you to do because, well, it's recency bias. This is what we've known in the past. This has been our record. This is what we'll do. We've got these IRR, internal rate of return pro formas that we're going to recap and refinance out in 24 months or 32 months, and you're going to get an equity multiple of 1.7 or 2.2, and your IRR is going to be 18 to 22%. Just throw it all out because they don't know. They can't guarantee you. What I do know is there's a lot of people that have to keep the funds moving, the capital moving, the syndications, because that's what they built their structure and that's what they build their whole lifestyle on. It's fees. It's all fees. And I'll talk more about that in a separate video to you about syndications, but it's all built on fees. And it's no problem when the market's going up and interest rates are low because everybody still does fine. The syndicators make good money, which I'm fine with that, as long as the investors make theirs. But you're being put in a backseat position as a syndicator. No, there is no alignment. Let me tell you, they're riding on your capital, and if it works out for everybody, bingo, everybody's happy. And that's the way it's been for the last 3, 4, 5, 6, 7, 8, 9, 10 years, but it's not going to be the same going forward, and I'm cautioning you that if you don't know what you're doing, and many of you don't, not because you're ignorant or stupid, no. You just don't know what you don't know. You don't know what questions to ask. You're buying the FOMO. You're looking at what people have done in the past, and you're saying, I want that to be me. You don't know what's behind the curtain or behind the door. Not that people are, I'm not talking about fraud or corruption. That's a whole different area. I'm just talking about people who are selling you what they believe they want to do because they need the money and commissions, and whether it works out or not, they make money. You may or may not. Do you want to put your hard-earned money on the back of something that has that much of a potential negative downturn? I don't. Now, I realize you haven't been through as many cycles as I have. In fact, many of you are in your first upcycle, sometime out of the 2008 great financial crisis. You've been involved as an investor for the first time in your life. You've invested money in stocks, bonds, mutual funds, 401ks, and probably some of you starting into real estate. And that's wonderful. I applaud you for jumping in and learning. But you don't understand that there's a full cycle. You've gone through a half cycle or part of a half cycle up. You haven't gone through a down cycle yet, most of you. Some of you have, and some of you have forgotten. But there's a down cycle. There's a correction. And the longer the cycle goes up, typically the harder and sharper the cycle goes down. Why do you want to ride that down? That's my question to you. Because you're impatient. We're all impatient. None of us want to hold out and feel like we're missing out what everybody else is doing. I'm just telling you, if you can't be disciplined and hold out and be more of a contrarian, listen, learn, talk to people, but be very judicious about how and when you invest your money. This is the way I lead my community. I have nothing to sell. I don't sell them real estate. I don't sell them anything. What I do is give them a place where they can come and curate the best information, the best potential opportunities, and know how to move their money through the cycle and not just focus on what everybody else has been doing in the past or doing right now. That's the focus of what I look at, and I hope you have the ability or find the ability to be cautious and patient in your own right, because that's the way a long-term investor looks at their future. Remember, it's your freedom. Stay focused on it.